Hey everyone, welcome to another episode of Brett's Brain. Today, we're going to talk about the differences between a SAFE, a priced round, and a convertible note. Hey, I'm Brett Brohl, former entrepreneur, current venture capitalist. Thanks so much for checking out the channel. Really hope you get something out of it. Our goal at Brett's Brain is to help entrepreneurs succeed, improve their chances of success. So if you have any questions, make sure you put it in the comment section down below. We'd love to answer them for you. And then don't forget to like, subscribe, share, do all those things. We love spreading the word and trying to help entrepreneurs on their journeys. Okay, so in the venture capital world, in the startup world, there's three ways that you can really use to raise outside money to bring into your business. So you hear about raising capital, raising a round of venture capital. What does that actually mean? How do you actually do it? Well, at the simplest form, it's literally going to investors. You get some dollars, you give some equity up for those dollars, and you put those dollars in your bank, and you use those dollars to then go do things like sell, market, hire, all that stuff. But how does what actually happens on the back end? Well, there's three vehicles that are really common in the startup world that happen all over the United States and across the globe, really. There's a priced round, there's a SAFE, and then there's a convertible debt note. All three of those happen every day in the startup world as a way to take money from an investor and give them equity, or in some cases, promise them equity in the future. So let's start with a convertible note, which is slowly becoming a bit more antiquated as SAFE takes over from the convertible debt market share, if you will. So convertible debt is actual debt, but what it is, it's you're going to give me money today, investor, and in exchange, I am going to give you the right to convert your money into equity in my company in the future. So convertible debt got really popular probably 2 decades ago, 15, 20 years ago. And the reason was because priced rounds were pretty expensive to get done with legal fees. There were more complicated documents, and you had to set a valuation that was associated with them. And so people wanted an alternative. And so they turned to a debt note, a convertible debt note, as a way to make it a bit more simple, and you could kick the can of valuation down the road. But what's happened in reality is with convertible debt notes, normally there's two terms that happen in those convertible debt notes, and this is the same on SAFEs. One is a valuation cap. So I'm going to give you $100,000, and while we don't put an actual valuation or a price per share on it today, we do say that the maximum valuation I'll pay you for your equity is $5 million, and I'm going to give you $100,000 today. And so no matter what you go and raise your next round at, the most I'm ever going to pay is $5 million with my $100,000, and that's the valuation I'm going to get. If you go raise at a $3 million valuation, I would get the $3 million valuation. So that's the way it's written, is that I'm going to get the lesser of our cap or whatever valuation you raise at. And so it's a way as an investor, I can put some money in. It's simpler documentation to get done. And I know at worst, I'm going to get a $5 million valuation with this valuation cap. The other term that's always in a convertible debt note, or almost always, is a discount. And oftentimes you see both a discount and a valuation cap. So a discount, you might see a 20% discount. What that means is that whatever you raise your next round at, your first priced round, you get a 20% discount to it. So same scenario, I'm investing $100,000 and I have no cap, but I have a 20% discount, and you go raise a priced round at a $10 million valuation, I'm going to get a 20% discount to that. So I get to invest at an $8 million valuation at that same point. And the reason I get to do that is because I invested earlier. I took more risk than that next round of investors. And so I should get a discount as an investor. And as an entrepreneur, you should appreciate that. Like, hey, if you invested a year earlier, that was a bit riskier than it is now for all kinds of different reasons. So those are the two key terms in a convertible debt note. A couple other things that differentiates a convertible debt note from a SAFE that are really important. One is it's actually debt. And so your debt note's going to have a term on it. Usually it's anywhere between 12 and 24 months. So at the end of that pre-agreed upon term between you and your investor, that note becomes due. And if an investor wanted to, they could say, hey, you have to pay me back all your money, all the money I lent you, plus this interest rate. And there's an interest rate associated with it, plus this interest rate. And that could absolutely bankrupt your company and put you out of business. And you need to be aware of that. Now, in reality, that very rarely happens. In reality, the person that put the money in, they don't want to bankrupt your company, because if they bankrupt your company, they're not going to get anything out themselves. They're not going to get any money back. But what it does do is it puts a moment in time in the future down where that investor, if you haven't raised a priced round yet, is going to have some leverage over you. They're going to be able to force you to come back to the table and say, hey, we need to extend this note, and or you need to, or we can call it. And some investors, not many, but there's some investors that might use that to their advantage to try and renegotiate rounds, to renegotiate terms, and things that aren't super founder friendly. Now, you don't see that very often, but it is a risk a founder takes when they use a convertible debt note as the vehicle to raise venture capital. And it's a big watch out. It's something that, for that reason, that last reason, just because there is this outside world where somebody might be able to leverage this note that's come due to change terms, pre-agreed upon terms with you as a founder, that I would push founders to use a SAFE instead of a convertible debt note when you're not doing a priced round. So a SAFE, the biggest difference between a SAFE and a convertible debt note is what we just talked through. SAFE does not have a maturity date. It never comes due. A SAFE also doesn't have an interest rate, so you're not going to pay a little bit more as a founder for raising money on a SAFE. But it has the other very similar mechanics as a convertible debt note otherwise, where somebody's going to give you money as a founder and say, hey, we're going to invest $100,000 and we're going to have a pre-agreed upon valuation cap that I won't pay more than, and a discount that we also will apply if it comes to play. And so you could have, again, a 20% discount and a $5 million valuation cap. And let's say you raise your next round at $5 million. As the investor, I'm going to get the lesser of the two. So if you had a $5 million valuation cap and a 20% discount, I'm going to take the 20% discount because that's going to end up being smaller than the cap. If you raise it $10 million, your 20% discount would be $8 million. But I had a $5 million cap. I'm going to take the $5 million cap as an investor. And those are things that you're negotiating. And those are the key terms that you're going to negotiate when you raise on a SAFE as a founder and as an investor. But it's a great vehicle to use. It's especially great for early stage companies that are doing friends and family, pre-seed rounds where you don't have a strong lead investor. And oftentimes founders are raising those rounds or doing self-led or party rounds. It's a great way to say, hey, we're raising money on a SAFE. We're doing a rolling close. So we're going to, as soon as you commit to me, we can take your money and issue you a SAFE. And you don't have to go through much more significant documents to do a priced equity round. It's a lot bigger packet, and it does take a lot more legal work versus doing a standard off-the-shelf like YC SAFE, which is really is the market standard. It's used by Y Combinator, and they're the ones that really originated and brought the SAFE note to premonition in the startup world. It's a pretty well accepted document, well thought of. Lots of lawyers have looked at it. It's pretty easy to get done. You can also, with a SAFE and actually a convertible debt note, do something called rolling closes. So when you're doing a priced round, there is a little bit of time once you do your first close to close the rest of a round. But in general, you kind of have to close everybody all at the same time. So if you're raising $2 million, you have to have all $2 million all at the same time when you raise a priced round. When you're raising on a SAFE, if you're raising $2 million, if you get a $200,000 check this month and then a $200,000 next month and a $200,000 the month after, and hey, that's $600,000 over 3 months you got it. And let's say that might be enough money for now, and you stop raising for 3 months, but you had it approved for up to $1 million or $2 million. 3 months later, again, you can open it back up and you can raise more money on that SAFE. And so there's a little bit more flexibility about raising capital on a SAFE than there is on a priced round. At least you don't have to go through as many formalities with your existing shareholders. Another key thing with both SAFEs and convertible debt notes is that in neither of those scenarios are you actually issuing shares. So the people that invest don't actually have any shares in your company at that time, which means for everything that requires shareholder approval, shareholder votes, all of that stuff, you actually don't have to go to them and collect those votes. You don't have to get their approvals. And that can be really beneficial when you're trying to move quickly. So you don't have to think about like, oh, we need to go chase down this teeny tiny investor that's on our cap table right now to get their approval or get their vote for their shares. And so it can help you prevent a bit of a headache as an early stage founder without having them actually own shares at that moment in time. It's not so you can be deceitful or undermine them or anything like that. It's just purely for operational purposes. It can be a bit easier for you early on. Now, a priced round. You'll have to raise a priced round. And when you raise a priced round, you're going to actually issue shares in your company to an investor. It is also the first time that you're going to have somebody's going to pay a formal price per share. So on the stock market, when you look at the stock market, you can go look at, what is this publicly traded company's share price? Same thing happens for private companies. Same thing happens for venture-backed companies. A share price is created when you do a priced round. And so somebody's going to pay you a certain amount of money for each and every share based on the number of shares you have outstanding and the valuation that you agree upon with those investors. And so really the big difference here between what we've talked about is you're coming up with a valuation of your company today that is firm. And you're going to put a bunch of docs in. There's going to be a variety of other things that happen at this point because it is a thicker packet of legal docs. You are going to want to have a great startup lawyer represent you when you go through this because there are a lot of nuances around control terms and who gets the voting rights on shares and who has voting rights on shares and common versus preferred shares. And so a lot of these things come up when you do your first priced round, which is oftentimes why early stage founders kind of kick the can down the road into a SAFE or a convertible note. But a price round is a great vehicle as well, and you don't have things like interest like you would in a convertible debt note. You don't have to worry about having a whole bunch of SAFEs stacked on top of each other and the dilutionary effects of those once you do a price round. You know exactly clearly who owns what and how much do they own. You also have a very clear understanding of who gets to vote on what and who has control over what. Are we forming a board? Is it preferred? Is it majority preferred? There's all these things that get answered in that moment in time. And we've done videos on some of the key terms in preferred notes in the past, and you should check those out. But that is what the basics of a preferred round. Just talked for a long time with y'all. Hopefully this was helpful, and we were able to describe the differences between a priced round, a SAFE round, and a convertible debt round. You'll hear about all three of them in the startup community, and it's really important to really grow your knowledge around that before you raise on any of those on any of those forms. Hopefully this is helpful. Make sure you like, subscribe, rate, review, and ask us questions. We'd love to help you in your entrepreneurial journey.